Good morning, welcome to today's webinar. It's Guangzi here. So because Paul and Lindsay are not around here, so we will skip the OCBC's results update and Fraser and FNN Health Management International's results update. So we'll start first with Sembcorp Industries results update. So we expect a turnaround in India's operation this year. So we upgrade our call to buy with a slightly lower target price of $3.83. You can see here the top line increased by 30%. Basically, it's because the higher turnover from Sembcorp Marine due to the higher revenue recognition for the delivery of jackup rigs and the adoption of the new accounting rules as FRS 15. Now let's review on the operations. So the utility Singapore operation remain flat and will continue to face margin compression due to the competitive environment as well as the higher raw materials costs. So for China side and India side, some of the plants are impacted by the seasonality. So for China, due to the extremely cold weather during first Q, one of the thermal plants has serviced for longer hours. So the net profit contribution from China side improved substantially. So for India side, because of low wind season in first Q, the SGIL reported losses, and also because most of the contracts, actually all of the contracts under SGPL were still under short-term PPAs. So as of first Q this year, SGPL continue to report net losses. According to the management, some of the contracts will be expired in May and June, and they expect these contracts will be rolled down, but still will be under short-term PPAs. However, the current spot and short-term tariff improve year on year, so that means SGPL's operation will improve moving forward. So for the full year basis, both the management and our side expect that will be profitable by end of this year. For the marine segment, as we mentioned during the Sembmarine's results update, the weak profitability will persist for the next few quarters. So the group's overall performance will be checked by Sembmarine's business in the next few quarters. So the next is China Aviation Oil. We maintain our buy call with unchanged target price of $2. So the business side, it was quite stable. So during first Q, you can see here the total trading volume improved slightly due to the trading volume of other oil products increment offset the drop in the trading volume of middle distillates. The drop in volume of jet fuel was because the backwardation situation continued in first Q. So that means the sales trading margin was compressed, and also the trading activities will be slowed down. But the bottom line still increased by 14%. It was mainly due to higher profit contributions from associates and JVs. So you can see here the profits from Pudong improved substantially. This was a big jump compared to first Q last year, 46% year on year. It was due to higher refueling volume and the foreign exchange gain during first Q. So the outlook for CAO is unchanged. We remain upbeat on its we remain upbeat on CAO because we do expect the higher profit from associates will continue this year. As we know that the fifth run rate in Shanghai Pudong International Airport has commenced operation in April, so that means the higher air traffic will continue to drive higher profits that will contribute to CAO. The next is China Everbright Water Limited. We maintain our buy call with lower target price of 55 cents. So you can see the results here all improve substantially, mainly due to the improvement of collection in account receivables and some projects that have tariff hike in first Q. So the positives are still the tariff hike and the upgrading of the existing plants for some projects. However, the negatives are the Zhenjiang Sponge City project was actually behind the schedule. So originally they expected the whole project will be completed by end of last year. However, due to some technical issues and as well as the climate disruptions, the project will be expected to complete by end of this year. It is worth noting that the Sponge City project is the first integrated project for China Everbright, so the learning curve for them was steeper than usual. The outlook for Everbright Water is unchanged because last year the authority initiated a clean-up move on PPP market due to the over-expansion of PPP projects over the past few years. So for this move, actually those like unsustainable projects or over-leveraged projects were removed or eliminated from the market. However, none of the projects that under China Everbright was suspended. So we think that this cleanup move will benefit the SOE such as Everbright Water. So in the long run, we think that as long as Everbright continue to maintain its quality in operations as well as the project acquisitions, it will be benefited from this ongoing PPP market reform. So next I will pass on to Richard. Oh, Paul, sorry.
Okay, yeah, hi, this is Paul here. Sorry for the rearrangement in the presentation. I will just run through the OCBC results. We titled the report "Provisions Vanished This Year." It's because that's what actually happened. But anyway, if you look at the results, the top line did well. I think the positives were at least the net interest income grew. The fees and income also grew, I think, but I guess it was below the rest. What was the highlight was actually, as you can see, the allowance collapsed to almost zero. Okay, but anyway, I'll just go through with you what we thought were the positives of the results and the negatives. The positives, which is a bit of a double-edged sword, but as we mentioned, the allowances, as you can see, they used the previous a year ago it was about 100 million. This dropped almost 150 million decline in allowances, which is obviously is obviously unrealistic because your credit cost, which is your provisions over loans, is only 2 basis points, where normally it's about 15 basis points. But anyway, then the other part, if you look at the other part is that the positives were that the gross NPAs. As you know, one way to track the asset quality is not so much the NPLs, because NPLs can be sold and so forth, which kind of can fudge the number. But what we look for is the new non-performing assets or new non-performing loans. So this is a positive. I think all three banks has exhibited very low new NPAs or new NPLs. But do know that OCBC did their one kind of like 1.3 billion spike fourth quarter, just to clean up the books. But okay, anyway, the other positive was loans growth was healthy, and as mentioned before, like consistent with all the data out there, Hong Kong is a big driver to loans growth. The negative, as you can see, is the trading income. It's part of the other non-interest income. That was extremely poor. That fell almost 120 million year on year. Okay. The NIM was also weaker. We were a bit surprised by that because most of the banks had better NIMs quarter on quarter. They blamed it on Indonesia and also on Hong Kong. Anyway, we downgrade to accumulate, but this is for all the three banks due to the price performance. But the earnings only met our expectations because of the collapse in allowances, which actually offset the trading income. So in the way how you want to view the results is that basically the income grew or about around like 10% plus, but the problem is that what helped the headline was the lower allowances. So it kind of underperformed the other two banks in terms of the operating results, because the other two banks were like mid-teens. Okay, this is just for reference. This is our guidance, which is roughly in line. As you can see, like mentioned before, the credit cost was the big. So we can expect it kind of made the results look better than it was because of the low credit costs, which is your allowances, your provisions. Okay. The only thing is the CET1 is about 13, so this is within their range. So it's going to be hard for them to raise dividends very high when it's just within their expected 12.5 to 13.5. As you recall, for UOB, this part here is about 14 or almost 15%. So that's why UOB can give you the extra dividends, because they don't need so much capital, whereas for OCBC you can see their capital is only 13, whereas UOB is about almost 15. Okay, this is just our valuation chart. Our target price is about 14.9. Their ROE, which is this part, which as you know is what we use to measure all banks, it's about 12%. It's between their ROE is just between DBS and UOB, with DBS being the highest. Move on to the non-interest income. No different from the other two banks. I think wealth management, of course, is the one, that part that's doing well. It's growing about high teens, and fund management too. The problem is this part here that we saw the collapse. As you can see, the trading income collapse almost. If you combine these two, the collapse is almost 160 million. For the loans, what did well is, this was a bit of a curious item which we need to clarify a bit more with them. This is where this jump is actually, this 42 billion of loan book is actually equivalent to DBS and UOB combined. So this is like loans to REITs and so forth. So this is where they saw most of the loans growth. In terms of currency, Singapore did well, and also Hong Kong dollar did well. So all in all, that's our last slide. All in all, among the three banks, this actually probably you can say ranked the lowest in terms of performance operationally. Okay, thank you. I'll move on to Richard.
Okay, thank you, Paul. Yeah, this is Richard speaking. I'll go through the results for 800 Super first. We maintain accumulate target price slightly lower at 130. Previously was 135. Our dividend forecast also remains unchanged at 3 cents. That will give you a 2.7% yield based on the last close price on Friday. So you can see revenue was 6% lower year on year. This was due to completion of term contracts and renewal of certain contracts at more competitive prices. These term contracts, one of them is quite a big cleaning contract. We'll talk a bit more about it later. You can see that EBIT level has dropped by 37% year on year. So they had higher OPEX, and this resulted in lower margin of 12.8% from 18.9% last year. And then bottom line is also lower, 37% year on year, somewhat similar to the previous quarter where they had a drop in the bottom line. So some of the positives is that while revenue was down 6%, staff cost was actually down by 12%. So this helped to cushion the impact of the lower revenue. This is a chunk of this came from their cleaning contract, which had been completed. So cleaning contract has quite a high portion of staff costs embedded in it, and then this was mitigated by the higher headcount at the sludge treatment facility, which is turning operational soon. I'll talk more about it in the next slide, next bullet point. So next bullet point is that the projects are on track and turning operational. First is the waste to energy plant. This is the one that will burn the horticultural waste and then convert it into steam and electricity. This waste to energy plant was completed last year, and it has already commenced commercial operations in February this year, but it's not running at full capacity now, and it's not it's still in a ramp up phase, so this is not really meaningful at the moment. The other one is a sludge treatment facility. So this is expected to be completed in June 2018. This has 4 trains, and one of the 4 already has been tested and commissioned and is ready. So the remaining 3 should be ready by June 2018. Next is a lower than expected revenue due to non-renewal of large cleaning contracts. So I mentioned this just now already. There was a large cleaning contract that was not renewed. So this contributed to the lower revenue. And then there was a higher OPEX as well. So among the operating expenses, there's this operating expense called supplies and disposal charges. So this was a 28% higher year on year, mainly due to two of their operations. First is the plastic recycling plant in Batam. They first announced this plant 2 years ago, but it has only recently obtained its operating license, and so it's starting to incur the startup cost now. The other one is iWash Laundry, which was acquired late last year. The laundry contributed to higher energy costs. So you know, the laundry, they need a lot of electricity and steam because of the heat that they need to do the laundry. So in conclusion, for the outlook wise, we're still positive on the business. Their new projects are going to drive earnings growth in FY19, so that's from 1st of July this year. Take note that their FY ends in June. And then the other thing is that a possible opportunity is that NEA has also announced the intention to develop an integrated waste management facility in Tuas View Basin. So this could be an opportunity for 800 Super to participate and grow the business in their core competency of waste management. Okay, now we move on to ComfortDelGro, which announced their results last Friday. We downgraded it from buy to accumulate only because of the positive price movement recently. Sorry for the typo here. The target price is 248, not 249. Our previous target price was 250. We maintain the same dividend forecast of 10.4 cents, so that'll give you a 4.5% yield based on last Friday's close of 233. Okay, so you can see revenue roughly was flat. It grew 1% year on year, and there was some positive currency translation of 5.2 million. That's mainly from the stronger pound, but EBIT is lower. There's a 1.8% higher operating expenses, and you can see the bottom line, the after minority interest, is almost 20% lower year on year, but that is because there was a one-off special dividend of 10 million in the first quarter last year. So if you exclude the one-off special dividend, the actual core PATMI is down almost 9%. So first thing first, as you know, SBS Transit is a subsidiary of ComfortDelGro. It's a 75% owned subsidiary, and for SBS Transit, they announced their results on Thursday evening, and there was a 64% growth in their net profit after tax. And actually this amount exceeded our expectation, and we realized that it's because of the bus segment. For the bus, they actually recognized their quality incentives for 2017 and 2018 under the bus contracting model. So these quality incentives is something like the bonus for meeting the KPIs. And then we think that the other thing that really moved the needle for them was the operation of shuttle services for the early closure and late opening of the East-West line. So if you remember, in the first quarter of this year, there were several evenings where the East-West line would close early, and then on the weekends it opened late, and part of it also doesn't open at all. So during those periods, SBS was contracted to provide some bridging services, and that was where there was the higher than expected profit for SBS Transit. The other thing is downtown line. The loss has narrowed quarter on quarter. In the fourth quarter of last year, it was its high at 15.6 million loss, but since then, because the stage 3 has opened, so now the full line is open for revenue service and there's no more startup costs, the losses can now narrow as the ridership ramps up. So in the first quarter of this year, the loss recorded was 9.1 million. So you can see that it has already narrowed down from last year. One of the for taxi wise, the fleet had Singapore taxi fleet had contracted 21% year on year, and this contributed to the 15% decline in the group taxi revenue. So this group taxi revenue is for all the taxi operations, which is in Singapore, Singapore, China, and UK. So they do not disclose the Singapore taxi revenue standalone, but at a group level for all the taxis. So this contraction contributed to the probably is the major contributor to the decline in the group taxi revenue by 15%. For the Singapore side, the idle rate was just under 3%. So outlook with there is mainly positive, mostly positive, but one negative. So I'll talk more about them. So for taxi, you know that there has been the consolidation of the private hire car industry, that's Grab and Uber, and then the incentives and rewards has been reduced, so there's some flow of drivers back to taxi, so that's a positive for the taxi segment. As for bus, this year they took over the Seletar bus package since 1st of March, so that will contribute positively to SBS Transit and to ComfortDelGro. For rail, positive is downtown line losses will continue to narrow. They expect to break even sometime in 2019, and then one of the negative is that Northeast Line and the Sengkang Punggol LRT margin will be capped at about 5% since they have transitioned to the new rail financing framework. However, at the same time, under the new rail financing framework, there's one positive, which is they will no longer need to incur capex to purchase new trains. Now we'll move on to the land transport sector. So we published a report last week, in the middle of last week. I'll just quickly go through the key points in that report. So the highlights is that ComfortDelGro is ordering 200 new taxis. This is their first purchase of taxis in the last 1.5 years. The other thing is that Competition and Consumer Commission of Singapore is in their investigation into the Grab and Uber transaction has not completed, and it's being overtaken by events as new entrants have already entered the market. Then meanwhile, the taxi population still contracts, and in fact it's an accelerated pace in March this year, while the rental car population stabilizes and its growth has moderated. So we maintain overweight on the land transport sector. So the positives is that the worst could be over for taxi. The purchase of a new taxi is a sign of recovering demand. The negatives is that some of the IMDs, there's an interim measures directives. This was given out by the Competition and Consumer Commission of Singapore. The IMDs, some of it are quite onerous on Grab and unlikely to be in place after investigations are complete. So in particular, there are two which are not really realistic. The first is the one where they have asked Grab to maintain their price, and the other one is where Grab is not allowed to access Uber's data. So we think that after the investigations are over, these among the interim directives, these two will not be in place after that, and so that will be a negative development for taxi. I'll skip this slide. Now for outlook of taxi, so I mentioned that the CCCS has not completed its investigation and they had some interim measures. The interim measures code is to preserve and or restore competition and market conditions. So what they want is to keep kind of like a status quo while they conduct their investigation. Take note that the shutdown of the Uber app was also extended twice, where the final day was May 7. While the investigation by the CCCS is ongoing, it has actually been overtaken by events and is quickly losing its relevance because competitors are already entering the market. So to tie in with the first bullet point on this page where I mentioned that they want to preserve and or restore competition and market conditions, they were afraid that without Uber around, Grab would be a monopoly, and then it would be impossible for new entrants to come in. But it has already been proved that the new entrants have already come in, and there are more to come as well. So you see, the the investigation was to determine if the transaction will result in substantial lessening of competition. Previously, when there were two players, there were no new entrants, but now after this transaction, in fact, there's more competitors coming in. So Jaknu and Ride are two of these new ride-hailing apps which have already commenced operations, and then a third entrant called Philo is expected to start by the end of this month as well. So you can see that there are people who are coming in to fill the space. Also, apart from losing relevance, the outcome of the CCS investigation will likely not be meaningful. Other than taking care of the interests of consumers, they also have to balance by taking care of the interests of innovative business models. So it's not likely that they would keep in place any onerous conditions onto Grab just for the sake of leveling the playing field. So new entrants have come in, but of course it's difficult to wrestle market share away. So what we've seen is that the new entrants are adopting innovative pricing models to overcome the barriers to entry. So for example, Jaknu, they use a reverse bidding system where drivers bid on lower prices for jobs. So what happens is that when a rider wants to go somewhere, he or she will input their location and their destination, and then the algorithm will come up with a default starting price, and then the drivers who want to take up that job will bid for the price, but every subsequent bid has to be lower than the last bid. So this is how they are this is their pricing model. So, and yeah, this is their pricing model. So it's different from how Grab and Uber has been pricing their rides. And then we also think that the reduction in the user discounts and driver incentives were inevitable. This is because the cash burn was unsustainable. All these discounts and incentives were funded by the private equity investors, but there's no profit. So of course they cannot keep on throwing cash indefinitely. So it was obviously unsustainable. Now this chart shows the historical taxi and rental car population. This dark blue line here is the taxi population. So you can, and this light blue line is the growth rate. So you can see that growth rate continues to accelerate downwards. The year-on-year growth in taxi was actually negative 19% in March this year. And then if we compare with rental cars, you can see that rental cars started growing sometime in 2015, and this is where it crossed over taxi to become more than taxi. Since late last year, we've been already saying that the growth for rental cars has stagnated. We saw this is indicated here where the grey line has stopped moving up, and then we also said that the growth is tapering. You can see that the growth, year-on-year growth for rental cars, which is the grey line, already plunged down and is now about 18%. Formerly it was almost 80, and now it's 18. Year-to-date wise, we see rental car population also stabilizing. Year to date, it's actually only grown 0.3%, and for taxi wise, year to date, it has contracted 6%. Yeah, so we've come to the end of today's webinar. We'll pause now for questions. All right. Since there are no questions, we will end the webinar here. Thank you for attending, and do tune in again next week.